Usually, like when we talk about a massive 50-year-old mega corporation, there's this expectation of, well, sluggishness, you know?
Totally. A company with 41,000 locations isn't usually known for being nimble.
Right. You picture a massive cargo ship, you spin the steering wheel on the bridge, and it takes like 5 miles of open ocean before the bow even begins to turn.
Yeah, you expect incremental changes, definitely not sudden pivots.
But looking at Starbucks' Q2 2026 earnings, I mean, that cargo ship is executing a hairpin turn right in front of us.
We are absolutely watching a structural corporate turnaround play out in real time, and the data stack we're pulling from today is pretty massive.
Yeah, what we got?
We've got their official Q2 fiscal year 2026 earnings release, which ended March 29, 2026, alongside an SEC Form 8K detailing a massive debt restructuring from May, plus some synthesized analyst notes on their strategic initiatives.
Awesome. So our mission today for this deep dive is to decode that turnaround.
Yeah.
We're going to unpack their highly publicized back to Starbucks strategy.
Right, and figure out the mechanics of that massive operational pivot they're making in China.
Exactly. And ultimately see what all this complex financial engineering actually means for their long-term health and stock value.
Because whether you are prepping for a portfolio review, catching up on retail trends, or you just want to know how the gears of global commerce actually turn, this deep dive is built for you.
So let's jump straight into the Q2 numbers. Consolidated net revenues hit $9.5 billion. That is a 9% increase year over year.
Yeah, and the metric retail analysts scrutinize most heavily is global comparable store sales, often called comps. Those jumped 6.2%.
It's a huge jump.
It is, and the mechanism behind that number is crucial. It wasn't just inflation driving up menu prices.
Right. It was actual foot traffic.
Exactly. It was a 3.8% increase in actual transactions, so literally more humans walking through the doors or hitting the drive-thru.
Combined with, what, a 2.3% increase in the average ticket?
Yep. Those customers spent slightly more per visit, either by, adding a pastry or upgrading their drink size.
Now, the earnings release notes that GAAP earnings per share hit 45 cents, while non-GAAP earnings were 50 cents.
Uh-huh.
And whenever a company reports two different earnings numbers, it usually means there's a story hiding in the difference. So what's hiding in that 5-cent gap?
Well, so GAAP stands for Generally Accepted Accounting Principles. It's the standard, rigid way a company has to report its finances, including every single messy expense.
The raw, unfiltered numbers.
Right. And non-GAAP is basically management's way of saying, hey, if you ignore the one-time unusual costs of our current corporate restructuring, here is what our core business actually earned.
I see. So that 5-cent difference represents the friction and the immediate cash cost of, well, turning that cargo ship.
Exactly. They are spending heavily right now to reorganize the company, and they want investors to look at the 50-cent non-GAAP number to see the underlying profitability once the dust settles.
That makes sense. And CEO Brian Niccol actually called this quarter the turn in our turnaround.
And he did, yeah.
Which brings us to the engine of this whole operation, the back to Starbucks strategy.
Right. The sources outlined 3 specific prongs to this plan.
Okay, what's the first one?
First is customer loyalty. In March 2026, they launched a reimagined loyalty program with green, gold, and reserve tiers.
And this isn't just about giving away a free coffee, right? It's like a behavioral economics play to drive that transaction growth we just mentioned.
Oh, absolutely. Gamifying the coffee experience creates switching costs for the consumer.
Switching costs.
Yeah, like if you are 50 points away from reserve status, you're highly unlikely to stop at an independent local shop, even if it's closer. You want those points.
Right. Personalizing that digital experience is how they secure recurring revenue in an increasingly competitive morning routine landscape.
Spot on. Now, the second prong is partner incentives.
The baristas?
Yep. They rolled out a new rewards program in April 2026, specifically designed so the hourly baristas share in the financial success of the turnaround.
But wait, if we look at the North America segment, their operating margin actually contracted, right?
It did, yeah.
It dropped from 11.6% a year ago down to 9.9% this quarter. So they are intentionally spending money on labor, which is eating into their profit margins today.
Yes, and management explicitly calls these labor investments. They've identified that customer service and speed are the primary bottlenecks for their growth.
Okay, walk me through that.
Think about the concept of throughput. If a barista is poorly trained or unmotivated because of high turnover, a drive-through order takes, like, 6 minutes instead of 4.
And the line backs up into the street.
Exactly.
Oh.
And a potential customer driving past sees the line, gets frustrated, and just keeps driving. That is lost top-line revenue.
So paying the baristas more reduces turnover, which increases speed of service, which captures that lost drive-through revenue.
Precisely. It's a calculated short-term margin hit designed to yield long-term operational efficiency. If throughput increases and customer satisfaction rises, the top-line revenue growth will eventually outpace the cost of those higher wages.
Wow, okay. So what's the third prong of the Back to Starbucks plan?
The third prong is optimization. They closed 62 underperforming stores in Q2.
Wow, 62 stores.
Yeah, 7 in North America, 55 internationally. And at the same time, they announced a new corporate office in Nashville, Tennessee.
Okay, aiming to build a strategic presence in the Southeast. So they're kind of cutting dead weight while expanding their corporate footprint geographically. Is it basically like pruning a tree?
Pruning the tree is a great way to look at it. You cut off the dead branches to feed the roots so the rest of the canopy can grow faster. Closing 62 stores out of over 40,000 might seem like a rounding error, but it signals strict capital discipline.
They're no longer subsidizing locations that drain resources.
Exactly. And the Nashville move is equally strategic. Historically, they've been anchored in Seattle, so expanding to the Southeast taps into a totally different talent pool.
And it probably diversifies their operational risk, right? Plus, it puts decision makers closer to their eastern supply chain and logistics hubs.
Yep, it's a very smart operational shift.
So they're completely remodeling the house in the U.S. But if we look at their operations in China, they aren't just remodeling, they are, like, tearing up the foundation.
Oh, completely. It's a massive shift.
Starbucks announced a joint venture with Boyu Capital. Boyu is taking a 60% stake in Starbucks China retail operations.
Right, and Starbucks retains 40% and will license its brand and intellectual property to this new joint venture.
To put this in perspective for you listening, at the end of Q2, Starbucks had 7,991 stores in China.
Nearly 8,000 locations. Moving from an operator to a licensor for that many stores fundamentally alters their risk profile.
Because running thousands of stores in a complex, heavily regulated international market requires massive capital, right?
Oh, incredible amounts of capital. You have to handle local real estate leases, hire tens of thousands of local employees, and manage local supply chains.
It's a logistical nightmare.
It really is. So
Yeah.
by shifting to a joint venture, Starbucks offloads the majority of that daily operational burden and financial risk to Boyu Capital, who already has deep localized expertise.
You know, it reminds me of the movie theater business.
How so?
Starbucks is shifting from taking all the risk of building the theater, hiring the teenagers to sweep the floors, and hoping the popcorn sells, to simply being the Hollywood studio.
Oh, I see what you mean.
Yeah, they license the blockbuster movie to the theater and collect a guaranteed royalty check regardless of how much popcorn gets spilled on the floor.
That actually captures the dynamic perfectly. Licensing is fundamentally a higher margin, less capital-intensive business model.
And the accounting impact of this shift is staggering. I saw in the earnings report that because Starbucks is selling off operational control, $5.04 billion of Chinese assets were moved on the balance sheet into a category called held for sale.
Yeah, and because those assets are now held for sale, accounting rules dictate that Starbucks immediately stops calculating depreciation and amortization on them.
The result being that their global GAAP operating margin expanded by 180 basis points year over year, hitting 8.7%.
Exactly. And just to translate basis points real quick.
Please do.
A basis point is simply 1/100%. Financial analysts use it to discuss small changes in interest rates or margins without getting confused by percentages of percentages.
So 180 basis points is exactly a 1.8% expansion in their profit margin.
Right. And a 1.8% expansion on nearly $10 billion in revenue is massive.
It is, but I have to challenge this. They just stopped depreciating $5 billion in assets, and suddenly their profit margins look incredibly healthy. Is that a genuine fundamental performance improvement, or is it just a clever accounting maneuver inflating the numbers?
I mean, it is a mandated accounting rule, but it is not a trick. It reflects a very real transition.
Okay, how so?
Well, depreciation represents the wear and tear on physical assets over time, right? Espresso machines breaking down, store furniture wearing out.
Right.
By classifying those operations as held for sale, Starbucks is signaling that they are no longer on the hook to replace those espresso machines in the future. Boyu Capital will be.
Ah, okay. So the margin bump from stopping depreciation today is just an early preview of the leaner, more profitable licensor model they'll operate tomorrow.
Exactly. It's a sneak peek at their future financials.
There is a heavy friction cost to this China pivot today, though. Reorganizing these entities triggered a severe tax impact.
Yeah, it definitely did.
Their effective tax rate jumped from 23.5% in the prior year to 29.8% this quarter. The report mentions an $8 million discrete increase related specifically to classifying these operations as held for sale.
Right. Moving billions of dollars of assets across international corporate structures triggers realization events for tax authorities.
So they basically got hit with a huge tax bill.
Pretty much. A discrete tax increase just means it's a specific one-off tax bill tied directly to this corporate reorganization rather than a permanent hike in their ongoing tax bracket.
It's the toll they have to pay to get onto the higher margin licensing highway.
That is a great way to put it, yeah.
So, with margins expanding globally and the heavy capital expenditures in China offloaded to a partner, Starbucks suddenly finds itself with a surge of free cash flow. What are they doing with it?
Well, on May 20th, 2026, they filed an SEC Form 8K detailing a massive cash tender offer to buy back their own debt.
Okay, they retired hundreds of millions in senior notes across multiple maturities. Like, they bought back over $321 million of their 2030 notes, $273 million of their 2028 notes, and $410 million of their 2035 notes.
Right. And senior notes are basically corporate IOUs. Senior just means that if the company were to go bankrupt, these bondholders would be first in line to get paid, making them a major non-negotiable liability on the balance sheet.
I see.
By buying these notes back years before they actually mature, Starbucks is executing a sophisticated financial cleanup.
Let's make this relatable. It sounds a bit like a homeowner who gets a massive bonus at work, and instead of buying a sports car, they decide to throw a huge chunk of cash at the principal of their mortgage to pay it off early.
Yeah, that's actually very close.
It frees up their monthly cash flow because they aren't paying that interest anymore, and it instantly increases their net worth.
The outcome is similar, but the mechanics of corporate bonds are slightly different. Unlike a mortgage where you just pay down the principal when a company executes a cash tender offer, they often have to offer a premium to convince investors to hand those bonds back early.
Oh, because the investors were expecting guaranteed interest payments until 2035.
Exactly. To make them give up that guaranteed income, Starbucks has to pay a bit more upfront. However, it wipes out the obligation to pay the interest coupon for the next 9 years.
And that interest adds up.
It does. In the first 2 quarters alone, Starbucks paid over $314 million in interest. Retiring this debt dramatically lowers that ongoing burden.
It lowers their debt-to-equity ratio and proves to the broader market that they have fortress-level liquidity. I mean, they have the cash on hand to simply erase their own debts.
Analysts absolutely love that kind of financial hygiene. In fact, CFO Kathy Smith noted in the earnings release that top-line improvement would come first, with earnings growth to follow.
And we see that logic directly in their forward guidance.
Right.
What they're promising investors for the rest of 2026.
Right. They are projecting global comparable sales growth of 5.0% or greater and earnings per share between $2.25 and $2.45.
They also plan to open between 600 and 650 net new stores globally. But there's a fascinating quirk in that forward guidance.
Oh, with the revenue.
Yeah. They project that 5% growth in comparable store sales, meaning the individual stores are selling more coffee, but they also project that their total consolidated net revenue will remain roughly flat year over year. How does that make sense?
How can thousands of stores grow their sales by 5%, but total revenue stays flat?
Exactly.
This circles back to the accounting mechanics of the China pivot. Under the old model, if a store in Shanghai sold $100 worth of coffee, Starbucks reported $100 in top-line revenue, even if their actual profit on that coffee was only, say, $10.
Okay, I follow you.
In the second half of the year, under the new joint venture, if that same store sells $100 worth of coffee, Starbucks won't report that $100. They will only report their licensing fee. Let's say it's $15.
But almost all of that $15 fee is pure profit because Boyu Capital paid for the milk, the beans, and the barista.
Exactly the point. Total reported revenue drops from $100 down to $15 on paper, making the overall revenue look flat, but the actual profitability of the revenue they do keep is significantly higher.
Wow. They're swapping high-volume, low-margin gross revenue for lower-volume, high-margin net revenue.
That's exactly what's happening. And looking at long-term value creation, management declared a 62-cent dividend this quarter.
The report highlights that this marks 64 consecutive quarters of dividend payouts with a 17% compound annual growth rate.
Which is incredible. In the middle of a massive structural turnaround and an expensive international reorganization, maintaining a dividend with that kind of historical growth is a massive consistency signal to long-term investors.
It proves the underlying engine is still generating reliable, distributable cash.
Yep. The turnaround playbook is executing smoothly. They optimized the North American footprint, structurally shifted the risk in China, and cleaned up the balance sheet with the debt buybacks.
But no corporate strategy exists in a vacuum. The macroeconomic environment definitely gets a vote.
It always does.
What happens if the global economy refuses to cooperate with Brian Nichols' turnaround? Let's analyze the critical risk factors projected for late 2026. Pulling directly from the forward-looking statements in the earnings release, what are the top 3 threats that could derail this momentum?
Well, based on their own SEC filings, the first critical threat is macroeconomic inflation and commodity costs.
So raw materials getting more expensive?
Exactly. They explicitly mention the persistent threat of tariffs and elevated coffee pricing. Starbucks buys vast quantities of raw coffee globally. If tariffs are imposed on imports, or if the commodity price of coffee spikes, their cost of goods sold skyrockets.
And if they cannot pass those increased costs onto the consumer by raising menu prices without losing volume, their newly expanded margins will just compress rapidly.
Right, which leads directly into the second critical risk,
Yeah.
consumer wallet.
A reduction in discretionary spending.
Yep. If inflation bikes too hard or a mild recession hits, consumers start auditing their daily habits. An expensive daily specialty coffee is historically one of the very first things to get cut from a household budget.
The elasticity of demand for a $5 latte is pretty high. I mean, if raw coffee prices force Starbucks to raise that price to $6, does this newly revamped 3-tier loyalty program actually have enough psychological pull to keep you buying your morning latte?
That's the million-dollar question. Or do you just buy a bag of beans and start making coffee at home?
That explains why the Back to Starbucks plan had to happen right now, before those macroeconomic headwinds reach full strength.
Oh, absolutely.
If you offer a mediocre drive-through experience with burned-out baristas, a price hike will send customers running instantly. But if you have highly engaged partners sharing in the financial success, a deeply personalized digital app, and highly optimized stores, you build a fortress of brand loyalty. They are desperately digging that moat today to survive those exact macroeconomic storms tomorrow.
Well said. And the third critical risk factor actually compounds the first two, and that's supply chain and climate.
Climate change affecting the beans.
Yeah. The report specifically flags the potential impact of adverse weather conditions and natural disasters on their supply network. Starbucks relies heavily on high-quality Arabica coffee.
And Arabica beans require specific temperature bands and high altitudes to grow, right?
They do, so extreme weather events, droughts, or unexpected frosts in regions like Brazil or Colombia directly threaten the raw supply of those beans.
Man. And when you compound a restricted supply of Arabica beans with rising global logistics and shipping costs, securing the supply chain becomes a massive operational vulnerability.
It's a huge risk. Even for a giant with sophisticated futures contracts and hedging strategies, a fundamental disruption in the dairy or coffee supply chain acts as a heavy anchor.
It really highlights the fragility of relying on agricultural commodities. You can restructure your debt perfectly and optimize your corporate footprint in Nashville all day long, but if the global temperature impacts crop yields, your bottom line is going to suffer.
Yep, nature always wins in the end.
So let's pull all these threads together. Starbucks has fundamentally altered its trajectory over a single quarter.
They really have.
They're executing the Back to Starbucks turnaround by pruning underperforming stores and making heavy calculated investments in hourly employee incentives to fix the customer service bottleneck.
Right, and they've completely re-engineered their international risk profile by partnering with Boyu Capital, shifting from a heavy footprint operator in China to a nimble, high-margin licensor.
And to top it off, they deployed their resulting cash flow to retire hundreds of millions in senior notes, instantly lowering their interest burden, cleaning up their balance sheet, and continuing to reward their shareholders.
They essentially managed to rebuild the engine while the car is still racing down the highway at full speed. It is a masterclass in aggressive, real-time strategic realignment.
So next time you pull into a drive-thru or walk into a Starbucks, remember, you aren't just buying a cup of coffee. You are participating in a highly optimized global financial machine that has completely re-engineered its balance sheet, its real estate portfolio, and its labor strategy over the last few months just to ensure you keep coming back.
It's pretty wild when you think about it that way.
It really is. And I want to leave you with a final thought to ponder. As Starbucks shifts nearly 8,000 Chinese stores to a licensed model where they don't even manage the daily operations, and as they focus so heavily on the gamified digital infrastructure of their rewards app, is it possible that the Starbucks of the future is less of a traditional hospitality and coffee shop company and more of a global tech, intellectual property, and financial logistics brand that just happens to sell caffeine?
That is a fascinating question.
Think about that massive cargo ship from the beginning. It didn't just turn around. It's becoming a completely different kind of vessel. Thanks for joining us on this deep dive.